and it catches up for what it might otherwise have done, and it goes ballistic. Well, if we have an eightfold move, like let's say the 2001 to 2011 move, gold would be $8,000.
Yeah.
And that's just doing what it's done before. And yet we have fundamentals that we've been talking about and macro technicals that are far more dynamic, both positives and negatives, that will motivate gold than any time in history.
So, Michael, no one has a crystal ball to know exactly where an asset's price is going to end up. However, with your scientific methodology, you likely could get into a close range with all the factors present. What's your analysis pointing to for the price of gold over the next, one?
I'm hesitant to say that, except I'll labor on that. If you look back at gold's bull markets in the last 50 years, in the mid-1970s, it woke up, it was in the mid-30s. And by 1980, 9 years later, 9 years later, actually, when I'm talking 1973 or so, 1980 was $850. Wow, what dynamics. Yeah, there were down moves in that. And then you take gold based around $260 in 2001, 2001, went to sleep. Okay. It went from 260 to 1920, did it in 9 years.
Yeah.
Wow. A lot of that occurred in the last year. Okay. Just like in 1979, 80, a lot of it occurred in the last several quarters. Okay, we started from a low at 1,050 in December 2015, and since then gold has moved higher in layers, which have tuned people to think in layers, not think dynamically. But the arm wrestling match bull trend, just like in 2010 to 11, 1979, ultimately says, I'm out of here, no more arm wrestling. And it catches up for what it might otherwise have done, and it goes ballistic. Well, if we have an eightfold move, like let's say the 2001 to 2011 move, gold would be $8,000.
Yeah.
And that's just doing what it's done before. And yet we have fundamentals that we've been talking about and macro technicals that are far more dynamic, both positives and negatives, that will motivate gold than any time in history. So, I throw out the 8,000 not as a technical target, but just saying it's done it before,
So you're saying that you do see it is realistic for an 8x move from that December 2015.
Why not? It's done it before.
And likely it can go higher.
Yeah, there's other factors out there that could take it off the page. There's some other analysts out there who, based on other factors, not just technical, that I respect, they're projecting in the 20,000s.
Well, I know Jim Rickards is one of them.
Yes, okay, that's one. Yeah, that's right. It was Jim Rickards. Another thing to look at, though, is silver versus gold. And think about it this way. You're looking at a copper chart and you're looking at a gold chart. And in 2011, they each made a high and pulled back. And again in 2020, and then for copper in 2022, made a higher high than that 2011 high. Okay, and then pulled back. And now this year, copper's taken out those two highs, and gold's taken out those two highs. Well, heck, silver should be above 50. If it's, what is it, a dog metal? Or is it an undervalued? I suspect taking out 50 on silver will not be its peak. That'll just be a wake up to people who suddenly realize something's going on here. And if silver went to a normal ratio, now a lot of people do the ratio thing, we do a percent. We divide silver into gold. How much is silver, an ounce, silver versus gold? Right now, it's about 1.3%. If you go back for 50 years, you'll find 20 years plus where silver has traded more at or more than 2% the price of gold, sometimes 3%. Okay. Well, $8,000 gold times 2%. Okay. It's off the page. So these are the possibilities that are not abnormal. It's just that
you think those can happen within the acceleration phase you're talking about.
The acceleration phase, yes. And gold miners, the same rule applies there. They're more undervalued to gold and to the stock market than they've ever been in history.
Well, I was just going to ask you about the gold miners. I was going to ask, Before you go further, I just wanted to put this out there. You know, some believe that there's a historic disconnect and the miners are going to revalue higher and get back to the equilibrium versus the metals. And others believe that price is proof that the market does not buy that the metals rally is real, and they expect the metals to fall. I'm sure you've heard this.
Yeah.
So you're clearly
metals follow, the miners follow, they don't lead gold. Okay.
Yeah, so you're clearly in the camp that the miners are going to play catch up and maybe go past. So go ahead. I'm sorry to interrupt. I just wanted to get that out there because there's two sides here.
Yeah, we've run spread charts showing XAU index, which has been around since the 1980s, versus gold. And then we also measure GDX versus gold. And for example, in 2020, silver and gold miners beat the pants off gold during that 6-month surge. Oh, they were far better places to be. They beat it 2-3-fold. But then since then, they went into this underperformance pattern. Just like their price went down, their spread relationship to gold declined. So they were underperformers. While gold held steady, they declined. That technical trend is broken. It broke at the same time the annual momentum of GDX and silver broke out. So did the spreads, which tells me that the performance trend of miners, not only is it vastly undervalued historically, but it's now broken out. So expect it to ventilate. And to the extent it's way overdone, it's got a lot of catching up to do. And I think that's why there's a lot of asset managers like Stanley Druckenmiller back in mid-February who dumped a bunch of large tech stocks and went into the gold miners. And, you know, people chuckled probably at the time, what an idiot, you know. Okay, well, you know, Newmont Mining, one of his picks, okay, it was like trading $31. Where's it now? 42? You know, in a matter of a few months. Pretty good percent move. And it's just begun. So I think there's an awareness out there among some asset managers, don't have to be gold bugs. They realize, hey, this category is just it's too cheap. You got to buy it.
You know, and to your point, Druckenmiller and some of those really, you know, larger asset managers, they don't buy something for a 10, 20, 30% move.
They're not.
They
traders.
buy something for a 3, 4, 5, 600% move.
And they don't buy it for the next 3 months. No, when they shift a position like that, like dumping 3 big tech stocks and buying 3 or 4 gold miners, and it's ongoing. He was one of the first, but there's others since. We know that. And I think there's a contagion once they realize that, for example, gold is not going to break back down. And suddenly, let's say gold goes up and gets above 2,500 or something. They're going to look at those miners and say, "Jeez, you know, they've been beating the pants off the S&P. They're dirt cheap." You know, the in-house technician comes to them and shows them the charts, you know, and they realize, one, they're buying cheap, therefore low risk, potential high reward, versus the stock market, which is the opposite. And it's like grabbing a wet bar of soap. That's a very little tiny sector. And when big hands grab it, it can squirt, you know.
So what message would you give to mining investors, both those who've stayed in through some very difficult times over the last couple of years and those who've gotten out, now that both gold and silver have broken through, you know, the several year resistance levels, gold has made new nominal highs and the miners are starting to move. What message would you give to these mining investors?
Gold is the mama. Okay, we know that. But during these phases, late in bull trends, now remember, we've bottomed in 2015, so it's a long time ago. It's been going up for 9 years, almost 10. At this point, if you enter the acceleration phase, which we think you do, that's when the gold miners are perceived to be vastly undervalued, and they're sold out, so to speak, and therefore they squirt. So if I were to suggest to an investor, I don't mean somebody buying calls that expire in 3 months. I own calls that expire in January on GDX, for example. I own calls on SLV that expire in January, near the money. So time is not an issue for me. But if you're buying short-term calls, yes, you're concerned about these little minor issues. But from an investment perspective, like outright buying the miners or outright buying a bullion ETF, I suggest silver and the miners, not gold. Gold's important, but it's going to lag those categories. And I think vastly.
Interesting. So you mentioned copper earlier. It surged in the last several months to over $5 a pound. It's since pulled back to about $4.65, I think is what it was today.
Yeah.
Michael, what does the surge in copper tell you about the global economy, the electrification story? And are you a believer in a sustained long-term trend move for copper, or are you expecting some kind of pullback?
No, copper, we've analyzed it and we turned positive some months ago, back when it was in the low fours, okay? And it surged above the last high. There's a level above copper that we haven't reached in this move, up around 520 area, let's say. You close a month out up there. In other words, you go back up to the recent high and take it out, close a month out up there, anytime next few months, let's say. And you should expect copper to accelerate. Now, it's not going to do what gold and silver are doing, but I could see it easily going to $7. Now, I won't speculate beyond that. Also, there's a popular notion that copper is reflective of the economy, and I don't buy that. I don't think that correlation works over the long term. It doesn't work. And this time, I don't think it'll work. Copper does have some supply problems. We know that. There's supply analysts out there who've told us for the last few years, copper's got a shortage in supply, and it's going to hit us. Well, so far it hasn't, but now it's starting to. We're seeing it in price. Mm-hmm. And I think that could help sustain copper regardless of the, quote, economic trends.
Okay.
So even if we go into a recession or depression, copper could have something strong here. It looks like it's one of the leading components right now within the Bloomberg Commodity Index. Whereas 2020 to 2022, energy tended to be. This time I think it's going to be grains and copper would be the components that stand out.
Okay. So, long depressed, long overlooked. You were just talking about the Bloomberg Commodity Index. The commodity asset category has been waking up little by little. And on some charts, the commodity complex is still historically undervalued.
Absolutely.
Are you anticipating a rotation on some level from general equities into commodities? What do you see coming for commodities over the next few years?
Well, when money flows, there's a river of money comes from central banks. Okay, we know that. They drop rates to free for 10 years and, people naturally will flow that money into something. The quantity is great and the cost of money isn't free, effectively. So you put it somewhere. Well, in 2008 and 9, it made sense. In fact, we put out a report 1 week before the low in March 2009, said this is the major low. Okay. We didn't know it sustained for 15 years. But back then they printed a lot of money. We know that, QEs. Okay. But sometimes the QE doesn't work anymore because you overprice a certain asset category. And so it's not an issue of the Fed printing more money. It's an issue of people reallocating from a perceived to-risk category into a low-risk category. So commodities, as you said, are very cheap. Bloomberg right now is 105 or so. We got up to 107 recently. It's been below 100 in the recent pullback. But if you look at its history, in 2008, it was 237. Okay, we're at 105. And in 2011, it was 170. So the last two peaks were way, way above where we are now. So just looking at the price history of commodities, they're still dirt cheap. Yeah. So if you get another river flow of capital from the central banks, this time investors are going to say, I want to put it in something lower risk that's behaving well. And therefore, it's going to flow back into commodity category and commodity stocks. Yeah.
Yeah, so you do see that. So let's talk about this river flow for a second. So, we've kind of danced around this topic of a monetary crisis early on. Do you believe, number one, that the U.S. is facing one? Number two, if so, how deep of an impact is it going to have? And number three, when the Fed does try to come to the rescue, you touched on this a little bit earlier, but I'd like you to go a little bit deeper on it. Are you staying invested in metals and miners during the crisis and pre-Fed intervention, or are you waiting until post-intervention to get back into those metals and miners?
No, I'm back in them now, and I expect to be in them for the rest of the year or a good chunk of the year. I think most of the move will occur before the election. And I think that's a factor that needs to be in people's minds. Everybody knows the country is divided, okay? University of Virginia conducted a poll of Biden and Trump voters that they published results, the University of Virginia Department of Politics, of Biden and Trump voters, and asked them certain very potent, pregnant questions. And such as, if the other side wins, is violence justified? and you would be shocked by the high percentage on both sides that said yes. I'm talking 20 to 30%. Other questions similar to that, would secession be justified? Equally high percentage of voters. If Trump loses, the red states want to secede. Even liberal voters under Biden said no, the blue states should secede if Trump wins. There are other questions similar to that were asked. Do you regard the other party as a threat to democracy? Yes, overwhelming number. This is not normal.
No.
And we know it's not normal. But how come it's not being priced into the stock market? It's a massive rip the
volatility issue.
Yeah, it ripped the tablecloth off, and all the dishes go flying. There is no outcome to this election, and I've been saying this for a year. No outcome to this election will be copacetic. None. I don't care who wins, Trump or Biden. The other side will not like it, and they will not like it in ways that you don't expect. In which case, price that in to a notion of stability and stock prices.
And likely people flock to safety when volatility rises.
Uncertainty. They'll look at what's their grandpa told them to buy and what they haven't bought. And they go down to the local pawn shop and buy some gold coins or whatever, you know.
So, Michael, let's stay on the topic of the election. I do have a question for you there. Okay. So both of these candidates are going to be a lame duck president come election day after they're elected, because neither can be reelected in 2028.
Right.
Okay. So we all know that there are a lot of fiscal, monetary, and debt problems that need to be worked on. They need to be changed, solved for the future health of the country. There, you know, we're in a pretty difficult and dire situation. Things such as Social Security, historic deficit spending, the trade imbalances, bond market. I can go on and on. But with their status being lame duck upon election, do you see that their likelihood to enact major changes during the next presidential term, since neither has much to risk, is now higher? In other words, they don't have to be conservative in order to get reelected, and therefore the probability of them taking a major change over the next 4 years goes up, or does it go down? Yeah, how do you see
it probably goes up, because I'm not going to say anything about Trump, whether I endorse him or not, because I don't, you know. But on the other hand, he stepped into a point in history, not that he caused or anything like that. He just happened to be there at the right time where these events, these macroeconomic political events, are hitting not just here, but elsewhere in the world. Okay. Europe as well. Argentina, what's just happened down there, the election there, totally threw all the cards up in the air. A libertarian got elected. In fact, he calls himself an anarcho-capitalist. Two dominant political parties have gone back and forth running Argentina for decades towards socialism. It hasn't worked. The economy's always been inflated. He's come in and he started to chop things up. So he didn't care. He's chopping parts of the government up and selling them, literally selling off the government. And suddenly now rental prices have started to come down to more normal levels for people who couldn't afford it.
They're in deflation, I think.
Yes, hopefully they are. They've had too much of the other.
Yeah.
But that's just it's isolated, but it's really not. It's not because Javier Milei is so magnanimous and, you know, magnetic type guy. It looks like a rock and roll star, but he's actually an intellectual. But he got elected by the youth vote. Just not that they understood what he was saying necessarily, but they just knew it was an alternative. Throw it all out. We're tired of it. Okay. That's starting to happen to some extent in Europe. We're having elections there where surprising minority parties are ascending. Parties that want to break out of Europe, for example. Parties that are doubting the EU and the money unit. Okay, so if we enter an economic crisis in the developed countries, it's primarily focused there, by the way. It's not in the emerging markets. It's mainly the U.S., Europe, so forth, Japan, where the central banks try to go to berserk again with the excuse of a breaking stock market, for example. And I think the Nikkei, by the way, is in the same vulnerable situation we are. That's going to shake things up, and also to the point where if a president, let's say if Trump gets elected, already the devastation will likely have begun in a way that people realize, like the stock market breaking down, let's say, in a way that the average guy in the street knows everything's no good. It's not just the inflation's bad, but even the stock market is telling me things are bad. The stock market's been a teaser. Biden has pointed to the stock market making new highs, economy solid and all that. But if you break that stock market, then suddenly that sentiment goes, you have panic in the sense of like in 2008 and 9, where it didn't matter whether you owned Lehman Brothers or worked there, you got laid off anyway. Mass layoffs everywhere. And people remember that. And so the fear and so forth between now and the election could increase dramatically, such that if Trump did get elected and did try to turn tables over, and there's a lot of people in Congress who want to, for example, there's a bill that's put forth to abolish the Fed. No, it's not going to pass now. But if we go into another crisis like this, and the Fed is seen as perhaps the instigator and certainly not the solver, then you might have enough votes in Congress to actually do something like that. In fact, we predicted the Fed won't be in existence in 5 years because of the nature of what's coming. Things like that could occur, and it won't take much on the part of let's say, Trump to make that commitment because he's got the excuse. We need to cut government spending. That's what a lot of the GOP people are saying. And if they start to, of course, it's going to be painful, but the pain will have already occurred before.
Yeah. So, and he's a lame duck, and so is Biden. So, regardless of who gets elected, it does seem like the table's being set for something big to change in our macro setting post-election, because they're not going to care beyond
but
that.
Regardless of the change in the policy due to the factors that come into play, let's say over the next several quarters, that attempt to reform, in other words, to cut back government spending and so forth, which would be painful. Of course, it'll already be painful before then. But there's the other issue of the uncopacetic nature of the outcome. There's no way it's going to be quiet.
Yeah,
I'm not going to predict violence, but I'm going to say that the streets will be filled, regardless of who wins the election. And
I tend to agree with what you're saying there.
How do you price that into the stock market?
Yeah, and it's a sad fact of the state of our union over the last couple of decades. We've seen this on replay several times. So, Michael, MSA has this 30-year track record of calling long-term trends before the crowd notices. The crowd typically waits until the trend is your friend, sometimes missing the big trends entirely. Your method allows you to spot these trends early. Is there a number one trend you're watching right now?
No, I think the gold trend is underway, period, done. I think T-bonds could fool people in that they are in a downtrend, and their annual momentum trend is negative. Even if they have a big rally, it's not going to last. It might last several quarters. And I think they could have that kind of rally. They have the technical wherewithal to get an upturn, but I suspect that will occur with the stock market rollover. In other words, asset flow out of the 60% stocks into the T-bonds. But the one I'm watching right now for the trend change that would be the downturn in the stock market. Not surprise us, but a lot of people. But two, watch the dollar index. Because, about a half a point or a point below where it is right now, it's going to suddenly wake up and become a factor again. It's been asleep for 2 years. So if I were watching for a new trend that would help dramatize what's already going on, it would be the rollover in stocks and a downturn in the dollar index.
Okay.
Very near happening. Very near.
Yeah. Well, this has been an incredible conversation. And before we wrap up here and I ask Michael our final question, I want to point everyone over to our Substack. It is free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and every single expert interview that we conduct. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive this free gift on us. Also, I am positive that you've enjoyed this conversation with Michael as much as I have. Please let him know. Hit that like and subscribe button and leave a comment below the video. Michael, in wrapping up our discussion, my final question is about portfolio positioning, and that's with the knowledge that you're not a financial advisor, but based on all we've discussed today and with all your experience and worldview as the backdrop, how are you positioning for the months ahead? What assets do you like? What assets do you absolutely want to stay away from?
Well, our analysis says one should be short the stock market. T-bonds might have a good rally, so there's a trade there, not an investment grade. It may last several quarters, et cetera, et cetera. Gold is in a primary trend, and it's accelerating, so is silver and the miners. So you could say, well, I want to be in all those. Actually, personally, I'm speaking now, and each person has his own risk, reward, and so forth. I'm emphasizing silver and the miners, and I'm assuming, and I think I'll be right, that as they accelerate, it will be, in effect, having a short position in the stock market, that will be a factor to help them accelerate, and that there's more dynamic in them in terms of percent gain potential than there is in even being short the stock market bubble in terms of percentage profits on downside or upside. So, in effect, I view my silver and miners position as effectively being short the stock market. Okay? And short the dollar, for example. Though the dollar correlation to gold and silver is not very good, by the way, historically, especially since 2015 low in gold. The dollar's only risen a tiny bit, and yet gold's exploded, so it's not been a negative. But anyway, so I view the gold and silver and the miners as effectively having positions in those other markets.
So I don't want to put words in your mouth, but are you also saying that you don't want to be in the S&P and the NASDAQ?
No, if I defined a point where I know the acceleration on the downside is beginning in the stock market, the topping process we're in, the point of breakage is not too far below us, by the way. Our reports update it month by month, week, day by day almost. What level, if we drop to on the S&P, that we're triggering resumption of the downside? It's not far below. No, I don't want to be short stock market because even if it collapses, it's not going to match the percent gain that we're going to see in gold and silver and the miners.
That would be magnificent if that happens. Yes. So, Michael, thank you for coming on to the Metals and Miners podcast and for being really so generous with your time, your analysis, and ideas. It's been incredible to spend this time with you. Would you please share with the viewers any final thoughts you want to leave for those tuning in, where they can learn more about your work and how they can connect with you?
Well, our website's olivermsa.com for momentum structural analysis. You can find out more about our methodology. We have a lot of our archived reports showing calling tops and bottoms in stock market especially, and request some samples. Happy to send them to you. But
you're also on Twitter?
Yeah, my son runs the Twitter page there for us as well. Anyway, when you go to the site, you can see that. But
I'll put all of that information up on the screen for everyone.
But, anyway, that's it's our timing is usually pretty good in major trend tops and bottoms. So it's archived and you can look at them.
Well, that is your expertise. So everybody go follow Michael and go check out the website. Read through some of those reports as I have. You'll come away amazed and you'll realize that you need to be paying attention more to Michael Oliver. Thank you so much. I look forward to having you back on, Michael. Thank you for being here with us. And everybody else, thank you for watching.
Thank you, Gary.
I want to point everyone over to our Substack. It is free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and every single expert interview that we conduct. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive this free gift on us. Also, I am positive that you've enjoyed this conversation with Michael as much as I have. Please let him know. Hit that like and subscribe button and leave a comment below the video.